Consumer confidence dropped in June. The Conference Board's report out today shows that it dipped to 100.4, down from 101.3 in May. Meanwhile, the expectations index also dropped to 73, down from 79.4 last month. An index lower than 80 historically signals a recession on the horizon. Joining me now to discuss is Mindy McIntosh, founder and CEO of McIntosh and Associates. Mindy, welcome. Good to have you. So last month, we saw consumer confidence break a 3-month losing streak. Different story this month. Why the sudden retreat?
I feel it depends on which consumers you're looking at. Our younger folks seem pretty optimistic. So 35 and under seem somewhat optimistic about this, not feeling like there's much of an approach that they need to worry about. I think they're feeling more that we're going to just kind of see the Feds need to kind of step in, reduce a little bit of our inflationary numbers that we've seen, and kind of see that level off so the housing market can change. And we haven't seen a lot of changes in their workforce. Similarly to the consumers that are a little bit more wealthy, 55 plus, they seem relatively untamed, so to speak, about what they're thinking about for current conditions. Yeah. But it's this middle sector that they're just not sure with what we're seeing with the housing market. We're just kind of seeing the stale fluidity here of where we're not seeing things move currently. They're wondering about job markets come in the future, elections on the horizon, and they're just feeling a little bit uneasy.
Yeah, I want to talk about all that, the wealth gap in a moment, but I do want to ask this pressing question because I feel like it's something that is on everyone's mind right now, the interest rates. What might this mean for the interest rates? Do you think we're still looking at a possible rate cut in September?
I do. I really think that we're still possibly looking at a rate cut in September because I think that the Feds are going to want to do that. If they can go ahead and do a rate cut, it's going to open up, I think, and where we'll see interest rates decrease. More folks will want to actually, even as well, when we look at the market, they're going to want to enter the market when they see more marginal rates at these reduce, so it can bring more dollars into being able to be used and be circulated. So I feel like we can see this happen so the needle can continue to move and get things more on the uptick rise while they can see things come into a demeanor where if we see kind of the market make a correction here, folks will feel that they can get back in because we've been so bull runish.
Okay, so you alluded to this a little bit earlier on, so we'll dive deeper into it. As we approach the election, many voters are asking themselves if they're better off now than 4 years ago. And in this economy, it seems the wealth inequality is growing, right? The rich seem to be getting richer, benefiting from the stock market gains. And the lower income groups, they're facing more challenges, like these high interest rates we talked about, buying a home. How do you think this economy has impacted the different socioeconomic classes?
I think that you're hit it absolutely right. It's going to continue to segregate. So most of the folks that we see, they're either trying to develop and start a plan. So those that haven't established a plan for investments and savings and looking forward to the future for their retirement plans, they're just wondering, when do we get in with the market high? It's really hard for them to feel like they can get out of debt. And if they moved or had to relocate due to maybe, let's say, an improved job, advancing their career, now they're looking at higher interest rates on their mortgage. So they're just feeling like it's harder and harder to get ahead for our younger consumers, where yes, our retirees or folks that are a little bit more wealthy, they can actually stand to gauge, hold on to some funds. Talking to some clients today, they can sit on units and even real estate that hasn't been moving because they have the capital to do so, and they can continue to keep riding the waves of what happens in the market because they can assume more risk, they have more wealth to do so, and then still being able to buy in and capitalize when we see some of those corrections happening. So we continue to see this segregation and this gap where I think it will help this fall if we do see some of the rates change to try to bring back some more level stabilized ground. But as of right now, even our retirees, we're seeing a definite segment between our younger and older generations.
So does that mean the middle class is shrinking?
I surely hope not, but it's really kind of bringing that. But I feel like we just keep getting more years young. So what we used to know of our retirees and our retirement made clear process, a lot of times it was 65 plus, and that's when folks were retiring and really looking at this wealth generation gap. Now we're really looking at much younger folks for that. So 55 plus is kind of that wealth gap that we're seeing, and 35 and under. So I feel like the middle ground is shrinking in age. I wouldn't say it's shrinking in numbers, but I do think that the age gap differential has definitely been transitioning, especially over the past 3 to 5 years.
Yeah, it's really hard for young people right now. Mindy McIntosh, founder and CEO of McIntosh and Associates. Appreciate your insight today. Thank you.
Thank you.
Of course.